presenting pre-qualification versus pre-approval.
I want to discuss with you today pre-qualification versus pre-approval. Your pre-qualification process is determining the amount of mortgage that you can afford. It is at this time your information is obtained, and it is here where your goals and needs are understood and coincide with your ideal monthly payment. The information obtained here will not be verified until your pre-approval process. This process is simply to create an idea of what mortgage you are looking for. The pre-qualification process is an excellent time for you to voice what your comfortable monthly payment is. I'm not paying your mortgage, you are. So it's of the utmost importance that you make sure that you are comfortable in paying that monthly payment. The pre-approval process is defined as a more firm commitment from your mortgage company. This formal process includes obtaining documents that include your state ID, or driver's license, your social security card, your W-2s, your pay stubs. If you are self-employed, I will need the last 2 years of your tax returns. If you are a veteran, I will also need your veteran paperwork. I will also need bank statements, retirement account statements, anything that would be pertaining to your assets. At this point in time, I will also be obtaining a credit report. The credit report is a useful tool not only to know exactly what your credit score is, but also to know exactly what debt that you're taking on at this time. It will also show me if you've had any late payments. It ultimately may end up showing me that this may just not be the time for you to be obtaining a mortgage. But I'm here for you. I'm here to make some recommendations. If that is the case, make some recommendations in order to guide you to your home buying goal. Whether it takes 6 years, 1 year, 2 years, we'll formulate a plan in order to keep you on track and ultimately obtain the home that you are looking for. After all the documents are obtained and a formal approval is provided by your mortgage company, your realtors, yourself and your realtor will be receiving what is called a pre-approval letter. A pre-approval letter is required to submit with your bid. This ensures the sellers that you have gone through the appropriate channels in which to be pre-qualified for a mortgage. The mortgage letter itself is pretty simple. It shows what the mortgage company that you've been pre-approved with, your name, your loan amount, the amount of money in which you're putting as a down payment, any seller's concession, and a span of interest rates. Neither the pre-qualification process or the pre-approval process guarantee you a mortgage, as confirming the property appraises in value, your credit doesn't deteriorate, that you remain employed, and that your information does not change will all play a factor in your pre-approval. Home is a lifelong commitment. In order to protect your financial well-being, I strongly suggest that this be your first step when considering buying a home.
Presenting the $7,500 tax credit for first-time home buyers and $8,000 revision.
Hello, in today's topic, we're going to talk about the $7,500 first-time home buyer tax credit that the government put out last year. This program started between April of 2008 and is extended to July of 2009, and that's the current program. Today is February 8th of 2009, and we're going through the stimulus program approvals in Congress and all, so this may change rather quickly. But right now where we're at is what this is in layman's terms is a free non-interest loan from the government. You do have to pay it back. Now the way it works is you get 10% of the purchase price in the home. So if you bought a house that cost you $65,000, 10% of that is $6,500. So that's all the tax credit you would get back. Now if the house was $200,000, you are capped at $7,500. So no matter if it's $200,000, you're not going to get $20,000 back. You're only going to get the $7,500 back. Now, as I said, this is a non-interest loan from the government, okay? So the rules are, if you got the $7,500 credit, you would have to pay 6.67% back per year for 15 years. And after calculating that, that's about $42 a month. So that's the way that would work. Now, there's some other qualifications to this program, and please remember, I'm not an accountant, so you want to talk to your accountant about this, of course. Now, to qualify for the program, again, you'd have to buy the house before July 1st of 2009. The tax credit is only good for home buyers that are considered to be a first-time home buyer, and you are considered a first-time home buyer if you did not buy a house within the last 3 years. Also, there's some income issues as well that you must qualify for. If individuals who file single or head of household, if their income is not more than $75,000 or the joint income is not more than $150,000, then you're good to go. There are some other limitations for households between 90 and 100 or something, but you again have to talk to your tax accountant. Also, the best website that I found, if you'd like to get some more details, is called federalhousingtaxcredit.com. That's federalhousingtaxcredit.com. The whole reason for doing this would be, people can borrow money from their friends or family, or I'm sorry, not from their friends, but from their family, and then their family can be paid back once the tax credit money comes in. That would be known as gift money, and you can talk to your mortgage broker about that. The other part is you can purchase either a foreclosure or an estate property or a house that needs upgrades, and you'll know that you're getting that money that you can do the repairs. So that's another way you can save in purchasing a home. Purchase a home that's not all updated, you can do the updates later. I hope this information has clued you in just a little bit more about the $7,500 tax credit. You can count on us in updating you if new programs do arise. Thank you.
Please stay tuned for the $8,000 first-time homebuyer tax credit revision.
And the changes to the first-time homebuyer tax credit from $7,500 to $8,000. There are several other parts to this update that I'd like to review with you. One of the major changes is how it would affect you and when you purchased your home. This revision for the $8,000 tax credit would only affect home buyers that purchased their home between January 1st, 2009 and December 1st, 2009. You would be able to get the $8,000 tax credit and you would not have to pay it back. Number two, first-time home buyers mean the same thing as before. If you haven't purchased a home in the last 3 years, you are considered a first-time home buyer and you may take advantage of this tax credit. You cannot sell your home within 3 years or you will have to pay it back. That is a new revision to the $8,000 tax credit. And finally, how can it be used? Well, it can be used in any way that you want. There's no requirements on how you spend your money. It's a tax credit, so a great way to spend it would be to purchase a home that may need some updates, get that lower monthly payment and the lower purchase price, and then do your updates with the tax credit that you get back. Also, you may be able to replenish savings from what you used for your closing costs or down payment. Hope this information